Welcome. Come on in. It's Thursday and it's happy hour. Home happy hour to be exact. So grab a drink and let's get started. Hi everybody. On this week's home happy hour, we are talking about FHA 203K financing. I know that is quite a mouthful and most of you aren't going to know what the heck that is. And to be frank, you're never going to hear that term unless you're looking at buying a fixer. So if you're buying a fixer-upper house and you don't have 25% down or you don't have a bunch of cash, the Federal Housing Authority through the government actually has a pretty cool program that you can use to have money to fix up the house. So a couple things you should know about it up front. It's a difficult loan to get, not difficult as far as income goes or credit score goes. It's just complicated, so it's going to take a little bit longer to do. Most of the time when I use these loans, it's going to be for simple projects that aren't like, hey, I want to remodel my kitchen. And because the problem with the kitchen remodel is it could be $30,000 or $300,000. And so it's a lot harder to manage, but this is great for a furnace, a sewer line, a roof, siding repairs, new windows, stuff that's pretty clear what it's going to cost, and it's not very likely to balloon into some big project that you didn't anticipate. There are two types of FHA 203Ks. There is the $35,000 and under. If you're under $35,000, it's a lot simpler, a lot easier to do. So again, back to those like system replacements, it's fantastic for that. There's a longer, more complicated form of this loan, and that loan requires that you have every single thing that you're planning on doing, and you have to have it line itemed with the contractor. So if it's going to be replace the floors, replace the countertops, you have to have a bid for every single thing. And then that whole scope of work is submitted to the appraiser, because what the appraiser is going to do is look at the house now, look at what you're planning on doing to it, and then they're going to add the value in for the assumed work that you're doing. So let's just say you're buying a house for $300,000, you're going to put $40,000, $50,000 in. So now we're at $350,000. And the appraiser is going to say, actually, after all this work, it's going to be worth $375,000. So they base your loan on the higher amount. Key is you have to qualify for that amount. So you have to qualify for that loan, but if you can, then it builds in that money for you to do the work. The one downside to this loan, a lot of people want to be able to do some of the work themselves. You can't. Unless you have a contractor's license. So if you are a contractor, you can do it that way. But usually these loans are typically people that don't have a contractor's license. So you can't do more than 10% of the work yourself. They don't want you doing it because they don't think you're very good at the work. And they're worried that if something happens and they have to sell the house, they want the work to be well done. A couple other caveats too, it takes a long time. It's probably going to take you 60 days to make this happen. But it's a fantastic loan for people that don't want a higher interest rate and they still want to buy grandma's house and fix it up. So I know this is super complicated. So if there's a bunch of numbers flying around in your brain, don't worry about it. I have people that can help you figure this out. So just leave a comment below and we'll get you in touch with someone that can help make this all very clear. And as always, thanks for joining us on this week's Home Happy Hour. Cheers.